Alrighty, so we're going to talk about the exam right now. Look at the items that are going to be on it. Again, I'm not trying to teach you the test. It is, I doubt that I'd get much pushback if I were trying to teach you the test. But anyway, I can do this in good faith, knowing that um, I've kind of figured out the important bits from the course. We just covered so much material, and it's obviously easy to get off topic and introduce a whole bunch more information than um, a lot of you might need. So I try to rein all that back in and give a pretty good review for the exam. So just like we're doing here today, we'll do it again on the final exam. Now the final exam is going to be proctored. It's going to be done through e-learning using the RP Now system, which is fairly, should be low hassle for you, but it's not something you just go on Blackboard and jump in and do yourself. You got to work with e-learning and their RP Now system. So anyway, but you contact them directly. What I do is I give them the test. We're talking for the final now. For the final, I give them the test, and then I'm kind of out of the loop. But what always happens is there's kind of a time crunch at the end of the term. I'm grading papers, I'm doing all kinds of other stuff, and so do let those guys take care of the administration of the test. It ends up with a better test, and also it simplifies the process when we're in the time crunch at the end. Okay, so on this exam, yeah, like it says, 40 questions, multiple choice, 60-minute time limit. You're obviously watching this video and you can use a calculator, but you probably won't need it because we're just gonna, look at a lot of like general concepts. There's not gonna be formulas. There's not gonna be lists of things. It's gonna be, fairly straightforward information that I think is relevant and that you could use. So kicking right off, we're going to talk about opportunity cost. Opportunity cost, and liquidity are two topics that are going to kind of beat you up if you don't understand them, because there's going to be probably several questions on the exam that relate back to it. If you understand them, then you're going to do well on several questions. So it's up to you. But opportunity cost, this goes back to day one. If you're doing something with your time, with your money, you're obviously not doing something else. Everything has trade-offs, right? And so, in terms of personal finance, um, when you make one decision, you give up something else. So if you go to Starbucks or a bar or whatever, and you're spending, 5, 8, 20 bucks, whatever per day on some, item, not to throw coffee and beer in the same category, but anyway, let's just say you're doing that. Um, yeah, that's a big chunk of money you're not going to have at the end of the month. So if you can find, ways to, um, you know, cut back on one thing, perhaps you'll have a little bit more to invest later on. So anyway, everything has decisions, and part of this too is, it's far easier to pay yourself first and just set aside your investment money at the first part of the month as if it's a bill, and then you're good to go. Okay. So another one on an opportunity cost. So there's a couple different options. Everything's multiple choice here. So which is maybe an example of an opportunity cost? Would it be purchasing a new computer? Indirectly, but there's not a trade-off there. You're purchasing a new computer. I guess it's implied that you're not purchasing something else, but there's actually better answers in here. Maybe buying a car rather than repaying your loans. That's definitely an opportunity cost trade-off there. What that means is, those loans hanging over your head and charging you interest are going to prevent you from perhaps buying a house and doing something else. And is this really the best time to maybe be buying a new car? Maybe again, avoid the dealer and buy something maybe, or even go to a dealer, but don't get the brand new one off the lot and suck up all that depreciation. But again, up to you. You'll make your choices and you'll endure whatever decision you make. When should you start retirement planning? So, you know, delay a little bit, wait a little time. Really, you need to start as soon as you can. And the most people go through this situation. They say, well, I can't put aside much right now. When I get involved in my career, I can put aside a whole bunch of money. Well, guess what? It's not going to be the same. That whole bunch of money you put aside when you're in your 40s, even it doesn't have enough time to work for you. You need that time value of money. So small chunks of money put in as soon as you can are going to end up in as vast sums of money in the future. So, if you're not living within your means, if your spending exceeds your income, what do you do? Sell some stuff, work more, do overtime, get another job. Maybe, the best solution might be to reduce your spending, live within your means. Um, so I know it's tough, but there's some temporary fixes you can do, but um, there's long-term consequences and inability to do certain things. Long term, you sell your stuff, you pretty soon you have no more stuff to sell, or you get so burned out at work, or perhaps they won't offer you overtime anymore, and you're committed to all these debts. So anyway, you need a budget and show some discipline. Um, Liquid assets. So what is a liquid asset? Is the big no brainer for this is real estate. Real estate is not a liquid asset. Real estate transactions can take forever. Sometimes they can go fast, but that is not the norm, especially if there's a loan involved. We're talking a while. And then there's this ability for anybody to kill the deal. You know, Nobody wants to go to court. You might win, you might lose, whatever, but you're going to spend money there, and so you'll have people at the last minute, get cold feet or whatever, and the deal gets tubed, and people just walk away. Very, I don't know. It's just anyway. The real estate is not a liquid asset. Liquid assets are cash or cash equivalents. Stocks. I would liquidity doesn't really imply wisdom. There's stocks are very liquid, but obviously if you didn't track things, stocks are way down right now. So it's a liquid asset because I could sell it and I could get access to the cash in a matter of about 3 days. But I don't necessarily want to do that. So anyway, but yeah, I would throw those into the liquid category. But if we're talking liquidity for the purposes of an emergency fund or something like that, yeah, cash or some sort of cash equivalent. Um, Remember from day one, we talked about short and long term. For personal finance, for IRS, for all those things, short term is defined as less than a year, and long term is greater than a year. So um, there's a list here. It says whatever. Um, what are these things? Some different loans like car loans and home loans and stuff. Is that a short term or long term liability? Obviously, it's going to be more than a year, right? So long term. And it makes a huge difference for a lot of purposes. If you sell something, let's say you flip a house, and you stand to make 30, 40 grand, or you get in on some great stock deal and you flip that, um, you know, within a month or two, or a couple months, or a day or something. Um, when you sell, yeah, you're gonna kind of get clobbered in terms of taxes, depending on your tax rate. It'll be taxed as normal income. Whereas if it's held for over a year, it'll be taxed generally at 15%. So, um, your personal rate's probably going to be in the 28, 30% range typically, and the long-term rate is 15%. So, that's why, even though, you make $1,000, your actual, $1,000 in a capital gain, that's what you call it when you buy something for less and sell it for more. But the amount of money you get to keep could vary. It could be, $850 after taxes. That'd be 15% out of that $1,000. Or it could be down as low as like 700 if you're in 30% tax bracket. And this is Alaska rates. You get to places like California and New York, and if you're making good money, I mean, their tax rates are like 63% when you combine the state and local. And oh, by the way, they're getting worse. So anyway, things to think about. Best measure of somebody's wealth. So yeah, it's not necessarily the kind of house they live in because do they own it? Net worth is a valid measure because net worth, what it does, it's your assets minus your liabilities. So just because somebody has a lot of stuff or they make a great income doesn't mean they're, that's a true measure of their wealth because if they're completely in debt, that definitely changes the situation. So wealth is measured. Best way to do it is net worth. Why do you want to keep track of your debt level? Um, so what can happen here is if you're not thinking about how much debt you have, you can get yourself pretty easily. I mean, that's why, when I'm talking about credit scores and all that, um, I'm not that worried about having a super, high credit score because you can get more than enough rope to hang yourself in terms of bankers or credit card people or you know financial guys trying to loan you money for consumer items. They're a little stingy when it comes to loaning for business stuff, but for consumer stuff, especially when it's secured, meaning it's backed by some sort of collateral, the car, the house, the whatever, they'll let you get way in over your head to the point where you can't pay your bills. I saw this when I was in the military. There's a Navy guy. He had literally his gross income was $25 less than a car payment. I mean, and they gave him a loan. I mean, they gave him a loan he couldn't pay. I mean, anyway, people will do that kind of stuff. We know about time value of money. We know that money received today is worth more. Um, well, if somebody offers you say $1,000 now or $1,000 10 years from now, you want the $1,000 now because you could invest that if you're smart, and with compound interest, that money will grow at a tremendous rate. So another one on time value of money, same sort of thing. Um, and just the notion of the concept of compounding, what's that mean? That means earning interest on interest, right? So if you're getting some 10% um, compounded rate on your money, let's say you got $100, that first day, what they're going to do is they're going to divide 365 days by 10%. So it's going to be a small number. But on day two, you're not just going to have $100 in the bank. You're going to have $100 plus, you know, 5 cents or 10 cents or whatever the amount is. And then on day three, it's going to compound again. So now you're going to have, $100 and 25 cents or something. Anyway, my numbers are I'm just pulling them out of the air. But the fact is, by the end of the year, you're going to be earning interest on, probably $1,200, $1,300 worth of money. So it's gonna be considerably more if it was just simple interest. Simple interest would be, 10% interest on $100 would be on $100 would be $10. On this one, it's going to be a little bit more. Anyway, that's why compound interest is important. And if you stretch that out to, 30-year terms, or in the case of the retirement example on the Excel spreadsheets, you can see where it just starts to go nuts. Um, Qualify a head of household. Yeah, you better have a child around. So there's different ways to file your taxes. We talked about this where, single is the least desirable. That's going to have the highest tax rate. If you're married, you can file that way, and the tax rate's going to be lower. If you're head of household, means that you're essentially single, but you've got some dependents. So you've got, a child, or I think in some cases an elder who's under your care. Anyway, if you can claim them, you're going to want to do so. And if you can do that, you're going to file under head of household status. But it means you've got to comply with having that dependent. Um, Here's a lady. She bought some stock, sold it. She got a price better, and that's just a simple math problem you can do in your head. So again, I don't think you'd have to pull out a calculator for these guys. Um, Sometimes they talk about tax deductible interest. That doesn't apply to consumer items, right? So autos, stereos, boats, things like that. There are no provisions in the tax code to give you any tax deductibility for the interest that's paid. So the exception to this is, well, not the exception, but the one category that does are homes. And that's why, home ownership can be a good deal because the interest you pay for that home loan is tax deductible. So, how do banks make money or financial institutions make money? They charge a higher interest rate than what they pay. So when they're paying, super low, um, return on your investments, um, don't be shocked when you see if you need to get a loan that the interest rate is, you know, double to triple that rate. Um, if you're trying to buy something like raw land, the interest rate is about 8%, and so the bank's making some money on that. Yeah, we talked about liquidity already, just quick access to money. One source of liquidity uh, can be, credit. Having a credit card that doesn't have a balance or having a good credit score and sort of a relationship with a bank where you can get access to quick money, that's good. But the disadvantage of that is that, you know, you need to have the means to pay down that um, essentially loan you're taking for your emergency fund, or else you're going to start accruing interest charges. Stopping payments on checks, not used too often, but that's a provision where you go to the bank and you say you wrote a check and you don't want that check to be honored, you do a stop payment on it. Now, if it's a legitimate thing that you bought and you're just trying to screw somebody, yeah, you basically well, you've committed a crime there, so that's bad. But if a check's lost or maybe there's some fraud involved, the business didn't deliver, you do have that stop payment option, which is nice, but make sure you know what you're doing before you do that. So you talk to the bank. Also, overdraft protection with any account, you pretty much need that. Mistakes are going to happen, and especially to keep extra thousands of dollars in your checking account so that you don't ever possibly overdraft is not financially smart. That's what the bank would like you to do because they get to use your money for nothing basically, um, or some fractional interest rate. If you haven't noticed, inflation is going up quite a bit, and yeah, if they can get your money and use it for free, they will. So the smarter strategy is to have overdraft protection and kind of max perform your checking account with not keeping a huge balance in there. It exposes you to less fraud as well. Um, Reasons to borrow money. Um, yeah, there's credit is a great thing, and the availability to get credit is a great thing. But if you're borrowing money just to get by, obviously that's not going to work. It should be some sort of temporary situation if you're, borrowing money for living expenses. You're maybe in between jobs or something's going on. But if you're just routinely borrowing money to survive, it goes back to that living within your means type thing. What do you want to do with credit cards? You want to pay off the balance every month. You want to be a convenience user. The If you need money, in terms of a loan or cash or something like that, credit card is not the place for it. That's some of the most expensive money ever. because they'll charge the double digit rates and all the rest of it, and it would be considered usury. You couldn't go to a bank and get a loan. They couldn't charge you that much rate, uh, interest rate. That's why the credit card companies are typically, like I said, located in Delaware or North Dakota or maybe it's South Dakota. Anyway, down in the Dakotas because they have exceptions to basically make the credit card industry locate in their state and they make money from it. But yeah, it's kind of hard over on the consumer. Um, so if you get a cash advance on a credit card, you're paying. You're paying right then. Normally you'll pay a convenience fee, say 10, $20, and then you're also paying interest. There is no convenience to this. I mean, in terms of no point in the process where they're not charging you interest. The way it works with a credit card is, they make their money two ways. They charge the merchant, the vendor or whatever, typically around 3%, and then they hope, that you don't pay your bill on time, don't pay it in full, and they get to charge you interest as well. If you pay your bill in full every month, then they get nothing from you. So that's why you want to be there. Now, if you use your credit card like an ATM and withdraw cash or use those little goofy convenience checks, yeah, then they charge you interest from right then. Um, yep. But again, use the credit cards, use those things. If it's a good component of emergency plan, I'm not saying like let's say your car breaks down, you use the credit card to pay for the repairs, you pay for the services. You don't draw cash out and pay the mechanic, unless it's some unusual situation. But most anything you need for emergency type things can be handled, with the credit card. So it can be a good component of your emergency, sort of fund. And as long as you have the resources or funds in some other location to pay it off, um, before, within that billing cycle, then that's a good strategy. Um, APR, if you hear that term, most of you know that's annual percentage rate. So you're always going to see, or you should always see, an interest rate that says, 8% APR. If it doesn't have APR behind it, it's probably a scam because, it's a legal requirement to let you know basically what the terms are. So of that loan, and if it's 8% and nothing more, if they don't have APR behind it, annual percentage rate, then you don't know the terms that are involved. Annual percentage rate means a specific thing that rate is annualized rather than something else. Anyway, how often should you review your credit cards? Obviously, as often as possible. And again, they're great people to work with. If you catch the errors early, you call them and things get taken care of. But things you got to look for: bogus charges, overcharges, and also it's kind of a good budgeting type thing where you look back and especially now where they categorize them and the annual things you can see just how much you're spending and anyway, but they're available online and that's much preferred method than waiting for the statement to come out. Collateral, we've talked about that. That's what means a gives you a secured loan, right? And it makes the interest rate lower because the lender has recourse. The lender will come grab whatever item is listed as collateral. And so it's not a signature loan. A signature is just backed by your word. Well, you can see what your word's worth when the interest rate is quite high. And this applies to credit cards as well. If you a credit card is essentially a signature loan, they maybe could come through in some sort of process and start seizing items you bought with a credit card. But if you have, say, a car loan that's specifically identified with such and such car with a VIN number, that's transparent. They'll come take that thing right then. So anyway, secured loans have the best interest rate because they're protected, they feel comfortable, and that translates to a lower interest rate. Um, if you're co-signing, kind of a bad idea. And yeah, everything's on the table. If you co-sign the loan, you are liable for everything. You're kind of liable for the actions of somebody else, which is not a good position to be in. You're buying a home. Should you use an agent or not? Personal preference, but in 99% of the cases, I would say it's a great thing to do because it doesn't cost you. The seller pays the commission. So, and then I've told you about for sale by owner homes a lot of times. And this isn't me. I'm not going back into real estate. I don't have a dog in the fight. But man, for sale by owner homes a lot of times have issues. People either wanted too much, or I've been involved in transactions after for sale by owner. And so you go to sell this home for somebody and they bought it under a for sale by owner contract, and there was just a lot of stuff that was skipped on the previous transaction that this new seller finds out they're on the hook for because they didn't get stuff done. It didn't comply with certain things. There weren't any inspections done. The bank, it can just, it's not good. So anyway, not to say there aren't good deals out there, or if you're buying something from, whatever, somebody in your family or something, yeah, by all means, there's no reason to pay, somebody 6% to help you with the transaction. But if you're out there looking for homes, and are just fresh to the situation, then yeah, I would typically use an agent. Um, what else? HOAs, homeowners association. I was dealing with this morning even. Yep, they can restrict items. I've got raw land down in Florida, and I just had to write a check for $750 for a homeowners association that I get zero benefit from. You know, it's just a bill. So I wish there wasn't a homeowners association, and all they do is squabble and talk about stuff. It's just yeah, it's like Facebook. Anyway, one disadvantage of homeowners associations is they can do that. I knew a guy up here in Alaska. He was a tree counter, and every person within the neighborhood had to have 3 trees or they're assessed a fine. And he'd have to go around looking at his neighbors, like some Stasi guy, making sure they had 3 trees. And by God, if a moose came and ate one of your trees, you're gonna hear from him. Life's too short. Anyway, um, da, da, da. Trying to figure out what this one says. Oh, okay. Fixed rate mortgages. So the great thing about a fixed rate mortgage is number one that the interest rate stays the same and the payment stays exactly the same throughout the course of the loan. So chances are, if you can afford that first payment on your 30-year mortgage by year 29, it's just going to be some incidental bill. I mean, it's going to be so low as opposed to somebody who say rented. That rent is going to be indexed with inflation. That $3,000 or $2,000 whatever mortgage is now going to be 5,000, 6,000 by the end of 30 years more likely, whereas that $3,000 30-year um, home mortgage is still going to be same amount. Adjustable rate mortgage, so that's an ARM, and you may see them more, especially if we get in this inflationary mode where interest rates go up and people, in order just to get in the market, are going to have to take an ARM with the hope that the rates are going to come down. But it's a little riskier proposition, but I've done it before, and it works great when it works great, but when it doesn't, it doesn't. So, but I got I think mortgage rates are about 5-6%, and my adjustable rate mortgage in Europe was like 3, and it was awesome. But anyway, we talked about risk management in terms of insurance and things, and what our risk management strategy. You can avoid risk. That's good. accept risks, suck it up. I've got the assets. I'll pay it off. That's how, like, state of Alaska doesn't have insurance. They're self-insured. And, if you've got deep pockets, you can do that. Or you can insure the risk. That's basically, transferring the risk to somebody else, to the insurance company. But to ignore the risk, just to pretend, it'll never happen to me, I'm going to go without insurance. That's not a management strategy. That's just hoping for the best. Good luck. Comprehensive. We talk about automobile type things. Yep, that would cover the kind of the cats and dogs, wind, hail, stuff like that. Um, Typically not, when the car's even moving. We know what a deductible is. If your car's damaged and has a couple $1,000s worth of damage, if you have a $250 deductible, well, the insurance company is going to cut you a check for 1750, or cut the repair place a check for 1750, and you got to come up with the other 250. What's not covered by homeowners policies? Flood insurance. So flood insurance is, it can just decimate an entire area. Everybody's a loser in that region, and yeah, so it's just not a viable business model. So it's illegal for private entities to offer flood insurance. Um, we talked about on homeowners insurance, if you've got some, fancy stuff, quite a bit of one particular category, read your policy, find out what's covered. But in likelihood, if you've got, a tremendous amount of guns or cameras or whatever, you're probably going to want a separate policy. And so sometimes they call it a rider. In this case, they're calling it a floater. But anyway, it's a personal article floater in this case. It's, whatever your insurance guy calls it, but it's the concept is you just need to, be upfront, identify what you have, and make sure you have coverage before you go to file a claim some years later. Um, Good way to reduce your premium would be to increase the deductible, and the insurance companies like that. I mean, and it's, for me, it's just simpler. You know, you whatever. If you have like $1,000 deductible, rather than going to the insurance company for small stuff, you just suck it up, and you realize you saved a little bit of money on your insurance, and they realize you're not going to be bothering about stuff. And if you have some sort of catastrophic loss, now you're covered. Although, especially as a lot of people found out in Alaska, they think they have some sort of coverage for earthquakes, and they perhaps don't. So that's definitely something you want to be cognizant of. You want to check, and this gets back to buying a house too. You want to make sure you don't, you know, buy a house and then inherit a bunch of structural damage. So it's kind of a different situation. But when you're looking at your homeowners insurance, specifically here in Alaska, you want to know what your earthquake coverage is, if it is there. And it's available again, but it may be so cost prohibitive where you're just going to say, okay, can't do it. Anyway, health insurance is expensive, as we all know. And, one way to mitigate that cost is that most people, as you saw on the slides from the other day, um, about 50% of people are, um, insured by their employer. So anyway, believe it or not, that's 40 questions. I think we're good. If you studied, you're going to do just fine. And let me know if you have any questions.